Hey everybody, welcome back to the Finding Financial Fitness Show. I'm your host, Nino Gonzalez, joined by my co-host, Chen, and our special guest again, Mike Kwong. Mike, welcome to the show.
Hello, good to be back.
We're back. It's been a long time. So for people listening, when this episode gets released, it's going to have been a couple of months, actually maybe a little bit more than that, since the last episode was released. But the last episode that Pei and I actually recorded has been quite a few months as well. And we discussed on the last podcast that we did that we were going to really be focusing in on bringing quality content and answering the questions of what people wanted. And we've gotten a really good response and feedback to what people really want to hear and what they benefit from on these podcasts and on the YouTube channel that we have. And a lot of that had to do with the velocity banking and going into the long-term projections, but also the number one question was, how does IBC, the infinite banking concept, fit into all of this? Because the way we talk about it, it's almost two systems happening independently. And it's very hard not to talk about it that way because you have to learn each system individually. But the real gold is made when you can combine the two and when you can actually see how the two are going. So that's why we brought Mike on. I mean, Mike is the guy for that. I mean, he wrote the book DIBS on Your Money. We've talked about that book multiple times on the show, but we really wanted to put numbers behind everything and show you the longevity and the durability of the system. So Mike, are you ready to talk about IBC? Is it something you feel comfortable with?
I've been pushing him to do this because you and I talk all the time and he seems to be kind of just mentioned in the background. And even though we all actually, I live in the same house with him and you are actually not that far from us, but to get all three of us together seems like a difficult thing to do. I don't know why. we're in the last couple months, if we combine the miles that we've flown together, it would be insane. So we probably went around the earth maybe twice, combining our miles done. So yeah, glad to be back together. Mike, thank you for joining us.
Absolutely. Honored to be here and appreciate the chance. So just like, Nino, you said, a lot of people understand, these two concepts as separate, but they are inherently driven by the same forces. All finance is run by the same, physics, if you would. And a key to that is velocity banking, as you've already discussed and had great episodes on. One thing, if you understand income stacking, right, there's just really, to recap it, is two sides to it, where you leverage some capital, right, with simple interest to invest into, from a bank, for example, a bank's line of credit into an investment that is amortized as far as the 36-month payment stream. So there's that positive gearing going on. So there's two sides to it, the bank and the investment, right? IBC, infinite banking concept, provides the bank, right? It is banking essentially through the use of properly structured permanent whole life dividend paying policies, life insurance policies. The cash values in those serve as the collateral with which you can then leverage for whatever purpose you need or want. The way they're built, the policy loans are not just flexible, but they're low in cost, typically very competitive, if not cheaper than, commercial credit, especially in today's rates. But more important, they're guaranteed, and they increase over time every year, unlike your line of credit or HELOC, which is time limited and subject to the bank's, qualification for your rates and everything like that. With policy loans, it's a set rate you can count on, for the life of the policy for the most part. So that aspect is one, concept to understand and master. And then the other side with the income stacking, that's another concept, right? But when you understand them each, you can easily, I think, see how they can really work together to serve each other's purposes and to drive that income stacking in a safer manner with, guaranteed access to the capital. And at the highest level, even it provide the investment or the amortized income from another policy, which, is a,
We're getting into the matrix now. When you basically tell people that
one
the
step at a
overlay,
time.
If you
One
just
step
tell
at a-
people before they fully understand, like, hey, by the way, you're going to use your policy as your line of credit, but also you're going to use your policy as your investment source. People just think, wait,
Whoa.
hold on, I'm just passing my ball back and forth. But we're going to get into that. We're probably going to end up doing this over a 2 to 3 part series, because we've had to lay the foundation, and now is when we bring the specialist on to really dive into it. And as you've seen with a lot of our recent episodes, Paid and Mike on this one now, they like to develop PowerPoints. Again, visual learners. You can tell they were teachers in the past, but also putting numbers behind it. So I'm going to pull up that PowerPoint that y'all did so we can go through it. Mike or Pay, whoever put this quote in, I love this quote, and I want to know kind of the reasoning why you guys chose this specific quote for this specific PowerPoint.
I did this slide because I love that story in Nelson's book, where he has this bunch of kids doing a math question that seems endlessly long, but this one kid who just kind of sat there, thought about it, and put an answer and figured it out, because he was able to see these numbers in his mind and was able to kind of, come up with a solution without having to do the actual calculation. And it's just about imagination. And as we get older and older, society or life kills that imagination, right? We get trained into just like, hey, this is the rule. You do it because I told you so. Don't think about it. I don't want you to have imagination. That's the way that the mass education is out there. But here is, we're trying to bring it back. What we're doing, what Mike and I do on a daily basis, just to try to spark people's imagination, because that's what Nelson's book was all about. It's just an exercise. This is a concept. It's not about products. It's a concept, and it's just an exercise, your imaginations, and sometimes maybe stretching your mind a little bit. So
yeah, I mean, the thing is,
I love this.
The thing is with the IBC policies themselves, it's often said, and I find it to be true, it is limited by your imagination as far as all the applications and things that you can use it for, whether it's to, finance vacations or pay off debt, as a velocity, sweep account, or to start building passive income. All of those are yes answers, so really what makes it fun is all the, almost infinite applications that you can use a policy for. And of course, it still follows the physics of finance and everything, but that's what makes it actually work. So,
yep. Well, and I'll move on to the next slide now, but I do want to mention something that I've personally learned as I've been doing this with you guys for a few years now, understanding that the more, because people might hone in on one specific strategy that they really, really like, and they think that that is the answer and everything else is irrelevant because they feel like they found their golden nugget. But the biggest thing that I learned, or have and am actively learning, is that the more systems and ideas within this concept, the infinite possibilities, the more you have in your toolbox, the better it'll be, because we as people, going into the psychology of it, we change as we get into different periods of our lives, and our goals might change. And if you have a tool belt here that you can use different strategies, maybe the goal at first is to really build up your stacks, really build up on that velocity banking. But then you get to a point where you want to protect, and now you want to pay off some debt. You want to clean up some of your cash. Well, you can use the same strategy as you mentioned, Mike, the kind of reverse debt sweep. But that's another option within the infinite possibilities. But if you're so closed off and only this one mindset and not open to learning more, you're kind of closing yourself off from other possibilities that may influence your personality, or vice versa. Your changes in lifestyle might change your investment strategy and your investment style. So I think it's very important to know as we go along on this.
Yeah, absolutely. In fact, for most people, in our experience with clients, they come to us saddled with debt. So, you're below that zero line, right? And you're fighting and swimming to get your way back out of debt. And then once you properly set up your policy and start sweeping all that debt and paying it off, you get to that level line. Now you don't owe so much or anything. Now what? That's when we start, adding passive income streams. So absolutely.
Or you could do it the other way. Going back to the infinite possibilities, you could do it the other way. You could say, you know what? I'm young enough that I can take this risk early on, and I'm at a negative, but I'm going to focus on the passive income and grow the passive income substantially enough that eventually it'll cover my debt, right? There's so many options.
Yeah,
absolutely. And it depends on what you want and how you're positioned in your horizons for life. Yep. Perfect.
So as we're moving on, we're going into the next slide, our mission, spark your imagination. So talk to us about these slides here.
Okay.
So you want to jump in? And I think this is where we're saying that this is a lot to unpack. So
Yeah,
we will not be able to get through all of it. So we'll try to
that's
get
right.
through as much as we can today.
Yep. So we did learn this, in at least past episodes we've had where we try to talk about it, and it goes on and on because there is really so much to it. But on the slide, as you can see, there's three boxes here. And the first box up top left, the green box is DIBS 1.0, we call that. And that's simply, the fairly simple concept of replacing your line of credit, or as some call firing the bank, right? Being your own bank, like it says there. Now, in doing so, obviously, we're replacing that with a properly structured IBC policy that offers low interest rate. Okay. And this is a rate that is not something you need to qualify for as far as your FICO score, debt to income ratio, or anything like that. It is set by the company. And as long as you can open the policy, you can enjoy that, for basically ever. Now, it's also guaranteed increase of capital that you can count on each year as you pay your premiums, which are also guaranteed never to increase. Your cash value base continues to grow. It is built that way. And that is, again, unlike any other kind of line of credit. And it's 100% under your control. Once you have it set up, no one can take that away. You can borrow it at any time without any request or explanation as for what the need is, as opposed to going to a bank for a loan or auto loan or mortgage to qualify for. So tremendous benefit there. The second box, the DIBS 2.0, we nicknamed lovingly the Teriyaki method. This is a higher level, application where now you can actually treat your policy purchase as renewal, as an authorized note. So,
Amortized.
Amortized note. Sorry, you don't have your glasses on. Let me talk this. Let me talk this slides.
Yeah, you can take this one. How about that?
Yeah, I'll take this one. So the DIBS 1.0, the reason why I put this slide together is because we have so many questions from people, and a lot of assumption after people read the DIBS on Your Money book that Mike wrote was just like, oh, okay, yeah, that's great. I'm just going to replace my line of credit with IBC. And that's kind of the 90, I would say 90% of the population out there. That's what they think of IBC is. And that's, through no fault of their own. That's just because on social media and when you go to all those like real estate investment, meetups and whatever, they all will have a IBC guru on the side that you can talk to because that's all they know. We're almost just scratching the surface of what IBC can be. Hence the imagination part. Yes, that is like the most basic application of IBC is to replace the bank, right? The next level, when those of us who are doing income stacking, is we're now doing these, periodic or regular investments. And Teriyaki came out of our group coaching, the method, and it's like, wait, if I'm going to invest in an outside, unreliable, unproven investment, taking a huge risk, why not invest in my own bank and set up when I'm doing a new stack? I have a plethora of choices. I can get into ground floor. I could get into net worthy. I can get into even, a high yield savings account if I'm super uber, conservative. But people forget each stack could be potentially a brand new banking system, IBC policy that you can set up. So that's why that first bullet is you can treat your policy purchase, your natural, you were growing anyways, you were going to insure your kids or your spouse anyways. Why not treat that purchase of a brand new policy setup as a amortized note that you're getting into?
To cut in here for a second, if I may, like to give some context, when we wrote the book, it was exactly kind of chronicling where we were. And we happened to have, be blessed with capitalized policies. As you read, I had, bucket A, or policy A and then policy B. And originally we started our income stacking with buying notes, right? Like unsecured notes from, Lending Club, which is a peer-to-peer, market for notes, unsecured, right? And we realized we're just buying other people's debt. So the understanding that, I can buy anyone's debt and make money with it instead of buying, anonymous borrowers that have unsecured notes that, could default at any minute. And they did once 2020 hit. we realized I have debt. Why couldn't I monetize my own and buy my own debt? So that was kind of the origination of that. But ultimately, most people don't have, or start with, two capitalized policies already. Matter of fact, they don't even have one. They may start to stack and understand, hey, this is great, this works, but I'm depending on a bank, right? I got to qualify for that credit. And then I'm not sure what the best investment is over here. So we already talked about part one, or DIBS 1.0 is, using a policy for the bank. But what if you don't have a policy? Well, we next realize that actually with a stack, you can use that stack, okay, to open and pay for a policy. That's the Teriyaki method. And in the same breath, use the available cash values that are immediately available as your 36-month income stream for that note, as an amortized note, or as your stack, or they call passive income or fast burning fuel. Okay, so that's what the Teriyaki is.
And the beauty of it is it's 100% under your control. That's kind of the repetitive theme here. You get to control when you're even, if you're investing with an outside investment product, they get to control. The company gets to control how much monthly gets paid to you, if at all. But when you're doing it within your IBC system, you have to be the honest banker. Right? So that's the only caveat, right? You have to be the one to be wanting to be in control of this whole system.
And that second line in the second box there, the $10,000, example of a stack, that could include the payment for the base plus the PUA. That's your entire first year premium, for example, for a policy. And from that policy, you can easily, move $300 per month of passive income from the cash values, the existing cash values, for at least 36 months guaranteed. If you understand, how these policies grow, it's completely available, it's guaranteed, and it's also tax-free. So it's a great place to set up that income stream to flow out of your own investment. And again, you can renew your policies as well with new money, as we call it, active income or investment income. And again, it's 100% under your control as far as like that passive income stream. Any other investment typically that you can find out there, you have to accept whatever that monthly payment is. And the balance of that, stack is locked up over the 36 months. Another advantage when you invest in the Teriyaki method or DIBS way, that cash value is ever present and available. You're simply using that monthly amount out of that total capital that's still available and growing regardless of, while you're using it. So that's the Teriyaki method.
And those are the two things we'll focus on this episode. We're going to do DIBS 1.0 and DIBS 2.0. The advanced strategies, which you'll see at the last box. This is, you have to fundamentally understand 1 and 2 to understand the third part. And 1 and 2 on its own are not that they're not easy to understand, because there's so many complexities within them. It's not as simple as leverage this to leverage that. Well, then we go back to personalities. Well, what if I want to take a detour and go this way? I'm going to do Teriyaki, but I'm not going to do this with Teriyaki. I'm going to go this way. Because of those options and limitless possibilities, if you don't fully understand right away what works for you, going into the advanced strategy is only going to confuse you even more, because now you're throwing even more and you're trying to juggle too many things. If you don't understand the fundamentals, you're going to let everything crash down on you. So the advanced strategies we'll talk about at a later episode, but just to kind of tease people a little bit.
This is almost like a choose your own adventure book, right? We're not saying, just doing 1.0 is bad. 1.0 is perfect. It's great. You are already doing better than your neighbor if you're doing 1.0, right? Absolutely. And in life, all we're doing is you just got to do better than the next person next to you, and you already are better off, right? So just doing 1.0. What did it say, Mike?
It's like if you're running from a bear, you just have to
outrun your neighbor. Well, I mean, it's not even. We're talking about 1.0 being 1.0 in DIBS, but we have to look at the big picture, right? We're already assuming the people that are listening to this, that are doing this already, you've already escaped the rat race mentality. You've already gotten away from the 401k mentality. You're already ahead of 80% of the population. But now you're getting ahead of the remaining 20% because now even just having a policy and letting your money sit in your policy, as much as this might hurt pay, it's like you're already better off than somebody doing a 401k or a Roth IRA or any of those. You've already taken control of your money. This is just saying, hey, you've taken control. And as we've experienced with all the people that join this, the moment they start doing that, they're like, what's next? And this is just answering the question of, oh, don't worry, that was only the beginning. Now here are the endless possibilities. So let's dive into the actual numbers, because this is, I think, where it gets fun. All right. This is where the mind starts coming blown. So let's go. DIBS 1.0. Let's talk about it.
So this is what I'm talking about when you go to these investment conferences and whatever. They always introduce an IBC guru that talks about IBC. And this is kind of what they introduce you to. I'm just going to summarize everything into one slide. All they're doing is telling you is get an IBC policy, take the cash value, however much you could get out of it. And some of them even push you to get as much as you can out of the cash value and put that money, 100% of that immediately into something risky, right? So that you can eke out a higher rate of return. So this is 1.0, replacing the bank, borrow against the cash value and put that into some sort of cash flowing asset, right? It could be a rental property. It could be buying out mortgage notes, car notes, private money lending, or it could be starting your income stacking. That's kind of the basics. And if you put that money into, let's say you have $50,000 cash value that you can access from your policy, you put that into, you leverage that as your down payment into a rental property. Let's say that's your 20% down, and you pick up a property for $250,000. And then your rental unit can produce, $500 monthly cash flow, hypothetically, right? That's going to take you about 8.3 years to pay off this $50,000 loan, right? If you take your $500, multiply that by 12 months, that's going to take you 8.33333 years to pay off this cash value. And then typically that's when you can re-leverage this $50,000 again out and buy your second property. And we're not even touching on the whole BRRRR strategy where you can refinance. That's a whole other bucket of worms that we don't want to open, but just on a very basic level, you can do that. And then if you add the piece of income stacking or velocity banking to this, what if I add additional cash flow to this engine that I'm building? Add a little bit of booster fuel, you can say, my own personal cash flow to this system. Then I can actually speed up the paying off of this $50,000, 8.3 years to less than 3 years. That's the power of velocity banking. So even within the 1.0 world, it's already mind-blowing. That's what I'm saying. You are already doing better than your neighbor if you understand 1.0.
Okay, so as a basis, example, how can we build from that? This is the question. So as we can see, all we've done, right? We took that excess cash flow, the positive cash flow of $500. That would take you over 8 years to pay off that $50,000 borrow cash down payment. And just by adding an extra $1,000 of cash flow, so it's $1,500 repayment, right? Then it cuts it down to less than 3 years. So this is one way, right, that most people can understand how velocity banking works.
I hope so. I'm not sure.
So the next slide, if we may.
Well, but before I move on, I just want to reiterate the point here. This is the part where when we start getting into the weeds of all of this, the reason why I want to pause at every point is because I want to remind people of the big picture. So right here, the natural inkling for people is to think, okay, well, it's going to take me 8.3 years to do this. I can speed it up at 2.78 years. I can be better. Just keep in mind though, with that mindset, there's always going to be something better to make it faster. But even if you were only, and I say only loosely, but even if you were only doing the one that takes you 8.3 years to pay off the loan, what do you have at the end of 8.3 years? If you did it the quote unquote slow way, you have your down payment paid off. Presumably you still obviously have your cash flow coming in. More than likely the cash flow is probably higher because rents went up. Your asset that you owned, real estate at this point, probably increased in value. Maybe not much, but it probably increased in value. And the kicker here is you have a capitalized policy. This is 8 years in. This is way beyond when, the fun starts happening with an IBC policy at year 5. So now you're at year 8 already. So look at all of the positive things you have by just doing the quote unquote simple, the quote unquote basic that everybody can understand. Now, as we're adding on, again, it just gets better and better and better from here. But even if you have to start here and you don't fully understand everything we're about to get into, like Pei said, you're already running miles ahead. So just keep that in mind as we move on. Because now, yeah, we can do it faster. We can do 2.78 years. That's another step. And we can continue to cycle that. Or, as Mike was saying, we could even get more advanced with this strategy with Teriyaki.
Perfect. Thank you for that. That's a great point. Okay. So this slide, DIBS 2.0, Teriyaki, explains how you would start with an income stack, or wherever you are. If your income stack is at $10,000, you use that to stack into investing or opening a $10,000 IBC policy, right? That's the purple box to the right. So you take the stack and you open a policy with it. Perfect. Now you're going to have immediately about 60% of that 10,000 in available cash value from the first weeks forward. So what do you do with that, right? You see the black line underneath that goes from the right back to the left. You can actually flow yourself monthly cash flow to the tune of over $300 a month to pay off that original leverage, right? Assuming your stacks came from a leverage source. Again, you could have an IBC policy or even a personal line of credit. Doesn't matter. That $300 starts to pay down that original debt. Now, in the box below, you're self-amortizing, however, this $300+ per month cash flow from the available cash values. Okay, let's be clear, right? This isn't from some anonymous source or some speculative amount. This is right there, guaranteed cash value that you're moving from the new policy, brand new policy. You don't have to borrow all that 60% out and put it back into this risky stock market or housing market or other people's notes. It literally exists there for your cash flow. And that comes back to you over, 12 months per year. And you can see the second line, $300 times 12 is about just under $4,000 of a balance per year for the next 3 years. Okay. The total cash value loan balance, because remember, as the monthly payments are coming back as fast burning fuel or passive income, it's building a balance or building a hole rather, right? Over time would be just about $11,000. You see 10,800. And then what happens is, you're 3 years out already. Your stack has fully paid out, but you do have a hole of about 11,000. So what can you do? Literally, you can renew not just your policy, but repay that debt with another stack, which of course, if we understand income stacking, has grown over 3 years, or with new income, right? Whether it's from job, investments, or a line of credit. And essentially you can rinse and repeat. And remember, from the beginning, the first year, you had essentially borrowed or recycled money, opened the policy. And as soon as, or year 4 or the end of the third year, you can again use that recycled money or the stack from your system to pay for the annual premium and repay all of those dollars that flowed out over the 36 months. And you just rinse and repeat. That's the most simple initial application or explanation of it. Pei, you want to say something?
Two points I want to point out. One is, if you don't know what the heck of income stacking is, because we jump right into it, you got to go back to the previous episodes. We have done so many of them already to really understand, like, what is income stacking? How does that work? What is monthly cash flow? We're doing advanced content here. Second is, I think whenever we say, new money, when you are talking about new money into this, people are thinking that they have to go out there and get a new job or somehow, beg, borrow, and steal for that money. No, when we talk about new money, it literally is just your regular income. Are you working? Are you earning income somehow? If you're earning income somehow that comes from a different source than your own personal cash already sitting on hand, even if it's interest earning from an investment, that's new money. Any dollar that flows through your hands in your checking account, that's new money. So you don't have to go out there and look for new money. New money is already there. It comes in every month, as long as you're not just sitting there not doing anything, right? Just want to bring that up.
So a couple of questions that I know come up when it comes to this. So question number one that I've gotten often when people are learning about both methods is, okay, I have access to a $10,000 line of credit. Do I do my stack first or do I open up a policy first?
Well, I hate to say it, but it depends, what's important to you or what your goals are. If you already have access to capital, right, like you explained in this example, then, there's nothing wrong necessarily with getting your stack started, especially if you're young and healthy, right? Now, if you are, because as your stacks start, building, every 4, 3, 5 months, you're starting to stack. And soon enough, whenever you're ready, you can decide to use that stack to open a policy even, right? So that's one line of thinking. Another example might be, you might be a head of household. You might, have family, that you care about and you don't have any insurance. Or maybe, and you don't have that access to a line of credit, right? Or you haven't opened it. Well, maybe then, but you do have some money to activate or open a policy with. You can open a policy and have that line of credit through the cash values that's available immediately that you can leverage right away to start stacking with. So right there, at least you've set up that net worth increase by the protection for the family with the death benefit. And you have a steady, ever increasing line of capital that no one can take away once it's open. So
I would say if you have money sitting in a savings account, you should activate it. That's lazy dollars. That's your money sitting in a break room, smoking and joking, and you don't want that. You want your money working hard for you. So activate that dollar into a policy, right? If you, and this is with a caveat that you can qualify, not. And granted, we do have to say, like, unfortunately, IBC is not something that everyone can qualify and get. And unfortunately, I wish it was not true. I wish it was something that, universally everybody can qualify for. But if you can qualify, and if you already understand the concept of having a warehouse, a safe warehouse or storage of your money, what better way to activate those dollars into something that's doing more than just sitting in a savings account, than to start your policy. Then use that policy into the DIBS system, either as the line of credit or as the income source. It is, again, moving pieces that you can move around, right?
And a third, variation of this could be a combination of that, or, where you can open the policy and use that policy as your teriyaki stack, so that policy is your first stack, and you are 2 for 1 doing, the same thing. You're starting your stacks with a brand new policy, right? That's the beauty of how this can work. It's not just one or the other. You could literally, with this move, start doing both. And then once you have that income flowing from the brand new policy, as whether it's $300 a month or wherever you start, and assuming, remember, we haven't mentioned, you have a positive cash flow. That's the requirement, kind of to get an income stacking started. But assuming you have that, now your second stack can be, into, Networthy or, Legacy Wealth or whatever, ground floor paper stack, right? And then start building that way. And then come around the anniversary 12 months later, you might be 3 or maybe 4 stacks down the road. Again, if you need to, you could just use another stack to pay for it, and that builds, consecutively. So we won't go too far there, but yeah, I mean, again, this is just an example of how flexible this can be. You understand how that works.
And I think, Mike, if you show like just an example illustration of how that cash value builds out, because I think, last time we talked to Mike, we had mentioned kind of just briefly overview of how a policy performs. But since we got him today again,
let's do it.
I think it would make sense more if people can see how that how that cash value builds over time in the non-guarantee column.
Okay,
this is the fun stuff.
Okay, perfect. So what we're looking at here, it's called an illustration, and this is a proposal that we can run for anybody depending on their age, their health rating, and the state that they're in. So at the top, this is of course our fictional John Doe, and he happens to be age 35. A standard non-tobacco rating with an annual premium of that $10,000. Remember, let's pretend we've got this $10,000 as a stack that he could invest into a brand new policy. So this is a table of how that policy looks. Off the bat, the base premium already purchases like $259,000 of immediate protection. Don't forget, this is life insurance. So the obvious benefit is that death benefit. So worst case scenario, he dies, he pays $10,000. his family still gets, actually about 280,000 here because the PUA also buys more. But my point is, it's life protection. Now, just to start.
Well, this is like a savings account, right? Your $10,000 that was sitting in the savings account, right? Now you just activate it, put that as a premium into your personal bank, and immediately this new bank, besides having your money safely, they're now building it up for you. They're investing your money on your behalf. They are guaranteeing you that if something were to happen, you drive out that parking lot, you get hit by a bus, immediately your $10,000 deposit turns into $259,000 cash out for your family.
Right. So again, that's not what IBC focuses on per se, but that is literally how all whole life policies are built. So that's the baseline benefit right there, which is tremendous. Now, to build from that, though, on top of that death benefit protection, which is important for, I think most people, we also have a cash value element to the policy. And this is something you can think of as the equity that builds within your policy from the get-go and it continues to grow and compound year over year. So if we look at this column here, the cash outlay schedules show your premium deposits. And remember, the $10,000 for those first year continues for the first 4 years. And what I didn't mention, but I have in many other episodes, and if you've read Nelson's book or mine, you'd understand that the $10,000 comprises of two things, right? It's comprised of the base premium, which is $4,000. And that's the, what the driver or what supports and builds that death benefit. That's your traditional port. And then on top of that, there's $6,000 of PUA, the paid up additions. And these are extra dollars that we can add to a policy. In this case, an IBC style policy, all of them should have PUA riders. The rider is just a feature that allows us to add the PUA. So you can see that literally for the first 4 years, we have the $4,000 base premium plus an extra booster or $6,000 of the PUA. Now, we already said the base premium provides the death benefit. The PUA provides that instant cash value. We sometimes call that the booster rockets. If you think of a shuttle, the base premium is your shuttle. That's the most important. It's where the astronauts sit. The mission's not successful unless it comes up and down all the way through, right? So that's for the life of the policy. And some policies run in lives from 25 years up to age 121, right? For the first 4 years, on top of that base premium, we have this PUA, the boosters, because on the wings of the shuttle, we also have booster rockets. So on top of, or with the PUA or with the base premium shuttle, we've got the $6,000 boosters. And that's important because the boosters provide the lift and initial momentum to get that shuttle, your mission off the ground. Same thing with a policy. When you're starting from day one, ground zero, you got a lot of boost you got to build. So that's what the $6,000 extra for the first 4 years provides. So long story short, we capitalized over the 4 years. And the first year out, okay, remember how I said the base premium's doing its work already, providing that $250,000 plus death benefit. Well, the PUAs get to work right away as available cash value. So the first year of the 6,000, you got about the whole amount there available. So this is your initial source of leverage or line of credit. Okay. Now, as we capitalize and build year over year in the policy, these are built to improve in efficiency. And this particular case, by the second year, as John pays in his second $10,000, remember 6,000 PUA, you might expect it to double to 12 or 13,000, but it actually jumps in the best type of policy by over $9,000. So imagine you're now enjoying 90+% efficiency just the second year alone, which is tremendous, especially for when you're doing something like income stacking, where you're using and re-leveraging these dollars 3 or 4 times a year. When you build your line of credit from 6,000 to 15,000, that's great. And it only goes, gets better from there. Because by the 4th year, okay, we're done capitalizing. That last $10,000 you can see is 98% efficient. You can see that it's like $9,800 or so that's available. But something pretty magical or really awesome occurs at the 5th year. This is that year when the shuttle no longer needs the boosters. We're already up out in space. We can drop those PUAs. And when we do that, we're $6,000 lighter. And when you pay just the base premium that year of $4,000, if you did the math to subtract this out, it's over $4,600.
So $39,848 minus 35.
Yeah, this is a cumulative total, by the way, right? So that's right. If you subtract each
46.56.
46.56. Thank you, brother. Right there.
Wait, so you deposited $4. Let's just use the.
This is the ATM. Imagine if you have a 5-year-old ATM and every $4 I put in gives me $4.65. That's what you have with a capitalized policy here. Okay.
How many ATMs do you want?
How many of these do you want? That's right. And that's just at year 5. Okay. Trust me, if you do the math, here it gets better. Just jump to year 10, for example, right here. When you pay the $4,000, and remember, we're just cruising at the minimum. That $4,000 results in $6,100.
61.3.
And now my $4 is giving me $620 to work with and play with and invest again and again and again throughout the year. So we can see that this is built to grow, and it does. It's just really fascinating. But my main point is to understand these cash values, right? And you can see how quickly they start to accumulate and grow. And off of the first year, remember, even at the 60%, which a lot of people poo-poo, I mean, if you build it right and you use it for the purpose of the teriyaki, it easily provides you that $300 plus a month, right, for the first year. Okay?
Because if we look at that slide from the teriyaki slide, Nino, let's just remember $6,000 of cash value year 1 available sitting there, the equity. If we're doing the teriyaki and we say, hey, I'm going to take out cash flow from my brand new policy, $300 a month, because this is a $10,000 policy, $300 times 12 months is what?
About $4,000.
Yeah, about $3,900 you need.
Okay.
Don't you have $6,000 in there?
Can you not guarantee that $300 a month or even $350 a month? Absolutely. Now, what about the second year? Because of course you're into months 13 through 24. You have an extra $9,500. Okay. Is that enough to cover the, again, $4,000 requirement for the second year of the stack? Absolutely. Plus more cheddar on top that you don't even, lock
that
up.
Could be sitting out as reserve, right? Because
it's reserve capital. That's the other thing you don't enjoy with any other investment. You have that extra cash value there if you have an emergency, rainy day fund, whatever you want to call it. All the while, it's still growing on your behalf tax-free. And then years, 3, 4, and 5 it's bananas, as far as that goes. So
speaking of tax, anytime you actually request a loan from your policy, that money coming in, deposited into your account, that's not taxable.
That's tax-free, correct. The way these policies are built, okay, as long as they respect and stay under the modified endowment contract limits, they're tax-free vehicles. All of the growth, okay, grow and compound on a tax-free basis. Okay, now on the other side of that, though, as you're drawing that monthly cash value, loan, there is some interest, absolutely. But the interest for policy loans is typically between 4 and 6%. Which is certainly what I'd rather pay than whatever my tax rate is for that outside investment that suffers. Okay, so don't forget that. And on top of that, more important than the rates themselves, who's getting the interest or the tax, right? If the tax at 30% or whatever your bracket is, that's going to the IRS, Uncle Sam. Nothing wrong with that. But now with policy loans, even the 4 to 6%, where's that going? That goes back to the mutual insurance company that you are a part owner of, who pays you dividends every year, grows and maintains your cash value or your death benefit, protects the family, all that jazz. So it's a self-interested cycle. And that's what's important to remember.
Because the interest that goes out to Wells Fargo, Bank of America, GMC, whatever bank, that interest, even if it's a, comparable 4%, you're able to get like a really nice line of credit at the same rate. That interest is one and gone. You paid it to them, and unless you are also a stockholder of the company, you're not getting back. So that's the difference between an outside bank and an inside bank. And IBC is an inside bank.
There you go. All right. Enough of this.
Oh, no, you can never get enough of that.
I know.
Oh, actually, Mike, you want to show? So we just went to Hawaii and did a IBC boot camp, and Jackie was in the audience, our daughter, and she actually had a great question. She actually scribbled down in the Nelson Nash's book, and I happened to open up the book that is her copy, and I saw the question. She didn't get a chance to ask, so I actually posed this question on the to the LSL team. And can you show what Crawford did? Yeah.
Let me
So the
see
question
again.
from Jackie was, can I see, or what is the ratio or of cash value in relation to death benefit? How does that look like? And here's the visual.
No,
Okay,
don't tell
let
me
me see.
your daughter asked that question, Pei.
Yes, she asked that question.
Did at 17. It was pretty cool to hear. But this is a visual representation to answer that question, the relationship of cash value to death benefit. So if anyone's heard me speak before about this relationship, remember I mentioned that the cash value is your net equity in the policy. Think about it this way, right? This is a long-term asset, permanent asset, and it's built out over several years. Basically the remaining years of your life. Every policy is a contract. And from day one, that contract guarantees that for whatever that annual premium is, a huge multiple in this, as far as death benefit protection. So I use the example of thinking of a tall tree in the late afternoon. This tree provides a shadow, right? From the get-go in the late afternoon. From the first year, the first day you open your policy, you might be 40 years away from, your death benefit. Okay, imagine you're 40 feet away from the tree. That shadow is going to be your present net equity. It's literally the cash value is also known as the surrender value. It is literally the amount that the policy or the company needs to pay out in order to absolve themselves of this looming liability, because it's there, it's live, it's on their books, and it potentially needs to be paid out guaranteed. So that's what it costs to buy you out of that debt, right? So literally your cash value is your present day value of that future liability or death benefit to you. So it's like a shadow that as each year evolves, right, as you make your premiums and anniversary, you're marching towards the tree. So when you do so, imagine what does that shadow do over time, right? It starts to grow. And it's built that way because it's based off of that curvilinear relationship. And I say curvilinear because what happens to a tree every year? It also grows each year. So the shadow is chasing up the tree, and the tree's growing as well at the same time. So in order to show that, we had Mike Crawford, our tech guy, draft this up real quick to answer Jackie's question, to show what it looks like over time. And there's only on this graph, this is 3 colors here. The blue is the premium schedule, okay? And this is a cumulative amount, by the way, if you look at it. And then the red is the cash value, and the yellow is the death benefit. So early on in each bar, if you would, is a year of this policy, right? And this is obviously a longer term policy, but you can see that in the first year, there's very little premium. It's almost, you can't see it there, but right away, there's tremendous, death benefit. Now, by the second year, okay, you're paying more premium, but you see a red line start to appear, and that is your cash values, remember. Remember that first year, we got about 60% of that blue line of premium as the red or cash value. But over time, fast forward, you'll see that the cash values quickly catch up to and then surpass your accumulated premium, your total premium. And all the while, your death benefit is also increasing slowly in the beginning, but certainly ramps up over time. But what ramps up even faster, and this is by necessity, is the cash values. So you can see that once the cash values pass, and even actually before by year 5, right? Once it passes your premium, it's on an upward trajectory, ever chasing up that tree's height or the death benefit, because the ultimate arbiter of your cash values potential is the death benefit at age 121. And that is this year 80, I guess 81 of the policy in this case. But you can see that it literally is built this way, where it's literally chasing down or up the value of that death benefit. So when people say death benefit doesn't matter, it's not true. It literally is the vessel within which your root system is growing of the plant. That is your cash values, the way I look at it. Your plant can never outgrow, the size of your pot or the fish out of the bowl. Think of that death benefit as that bowl or that pot that, everything grows within. So, and you can see even here, the blue stops, right? That's your premium deposit. At some point, for all policies, you don't need to pay anymore. That's like paying off your mortgage. everything at this point is gravy. And that's a heck of a lot of gravy and mashed potatoes right there, that just continues growing. There's no stutter as far as that built up growth, and it just continues to so.
And for those people in the audience who have watched the episode where Nino and I went over and we laid out the 20-year income stacking plan with the $2,000 personal cash flow input, if you were just to, in your brain, use your imagination and overlay that graph over this one.
Hey, can we give Crawford that assignment? Because that right there, I'm just kidding.
Mic drop.
That right there is that's the point I was making at the top of the show. And I'm glad you kind of brought this up now, Pei, is as we see them both in isolation, they're powerful. Just seeing this and then seeing the 20-year outlay. I think on the 20-year outlay we did by year 20, monthly cash flow was at like $120,000 a month that you were getting. Now, of course, a lot of that's amortized, so you can't just bring it down and spend it all. But even if you assume you only, quote unquote, only can burn off 10%, $12,000 a month, plus what you're getting on the right hand, which is at that point, the growth of your IBC policy, presumably you started them around the same time. Well, now you have a significant amount of money that you're getting from the IBC policy tax-free into your account, plus the $12,000 that you can quote unquote live off of after 20 years. So why would you not start this sooner? And that goes back to, again, one of the questions that I made earlier on about, well, should I get an IBC policy first or should I start my stacking first? I was always under the camp of, well, let me get my stacks going first. But then you realize, well, you can stack at any time. The limitations preventing you from stacking are yourself. The limitations preventing you from getting an IBC policy are your health. And you, as you well know, Pei and Mike, like something can come up at any point that can limit you from getting an IBC policy. Some health condition could come up that you don't even know about. And I think the sooner you can capitalize on that, truly the better. And I think just one more point, and I wanted to get into I wanted to ask you, Mike, but I know we're kind of getting into the weeds here, but that illustration for me sums up, and tell me if I'm wrong, but that sums up the reason why a 40/60 base is so much better than a 10/90. Because if your growth is based off of the death benefit, if you shrink that down to get maximum cash value in the beginning, well, then you're shrinking the potential upside growth of that, correct?
Yeah, that's absolutely right, because you're sacrificing the shuttle. Remember that analogy, okay? It sounds all sexy to have bigger boosters, but for the same $10,000, what you got to do is kick off 3 of those astronauts and shrink that shuttle from a $4,000 shuttle to a $1,000 shuttle, right? Or whatever. And that's the trade-off. Right? PUA dollars are great for the first couple years, maybe. Why? Because they have 100% efficiency to add to your base cash value or your cash value total. But advantage soon is outstripped by the ever compounding efficiency of the base premium, which, remember, although in the beginning primarily serves to set up that death benefit, also gets more and more powerful and efficient to provide additional cash value over time. That's why at that 5th year, it's so powerful where only $4,000 of base with no PUA increases the cash value by 46.56. That's huge. To add another 4,000 of PUA, here's the misconception. They think that I'll add another $4,500 or $4,600 to it. No, it doesn't work that way. PUA is more or less limited to that 100% efficiency, but it's for the life of the policy, which again gets outpaced by the base premium. So real important point. Thanks for bringing that back up.
And that's thinking long term. It's all about thinking long term.
That's rule 1 of IBC. Think long term.
And I think just also if you got to see the big picture. I think the more you can understand and the more you can study, the more you can learn, the more you can, if you still to this day, whatever you are on your journey and you feel like funding a 40/60 policy is quote unquote slowing down the growth, you're missing it. Because even if you believe that though, understand that what you're doing on the left-hand side with the income stacking model is going to offset a lot of what you're quote unquote losing with the 40/60. So it's an argument for DIBS, which is marrying the two of these together, because you're allowing for the long-term growth of your IBC policies, and simultaneously you're starting your stack size that when, again, going back to that 20-year outlay, when these things are reaching their maturity for you, they're maxed out at their maturity, as opposed to having one, maybe doing a 90/10 policy or 80/20 allowed you to stack bigger, but then you're losing the long-term growth of the IBC policy. And I think that that's where a lot of times things get lost. Because right now, I mean, I haven't had a policy capitalized yet. Like I'm barely in the beginning, and yet I can see it, but you have to have that vision. You guys have seen policies, capitalize, and I see your illustrations and I'm thinking, man, I can't wait till I get there. But it takes that level of, and again, going back to the name of the show, finding financial fitness, it's the same methodology of getting fit. You're not gonna go work out at the gym and the next morning, overnight, your body's transformed. But the consistency, the going in, getting the reps done, eating the clean food, eventually out of nowhere, you're gonna start seeing progress. And it's the same thing in this world.
Perfect. That's a beautiful analogy. I love that.
That's why I love.
One other one
I do love it.
Is with that 80-20 or 90-10 policy, think of a Pinto and a Ferrari. You could redline that Pinto, and that's essentially what you're doing when you have a 90-10 policy. Okay, it's already max filled from the jump start. But when you redline any car, you're going to break it down much quickly. I'd rather cruise at 3,000 miles or RPM with a Ferrari. Okay, you'll get a lot further and faster over time.
And cooler.
Maybe not Ferrari, but depending on how long they last. But you understand, right? You can do something right away and then have limited benefit down the road, or you can start more conservatively, built for the long term, and understand you will grow into that efficiency. Yeah.
Well, I use the three little pigs, right, as an example, right? You can build
a
house however you want. You can build a house using straw, and you can move in today, right? Or you can take a little bit of time, maybe the 80-20, you build it with some sticks and it will last maybe 10 years. And then now you have to go and find a new house. Or look at Nino's background. You can build a house with bricks. That's going to last forever.
Hey, you're the straw with all the wind just blowing around.
Yeah.
Nino's the bricks. I love it. That wasn't even planned, guys.
That was planned.
This is tinfoil. This is tinfoil, guys.
Worse. That's tinfoil. Okay. Okay. Enough.
Well, I brought up the 90-10. That was my fault. I know that gets Mike's ears going all the time whenever we bring in 90-10.
Yep.
But I mean, you can see, going back to you can see the possibilities with everything. I mean, I want to reiterate the point. We're just skimming the surface. Teriyaki is right at that middle ground where it's okay, cool. And what Mike said earlier on, a few years ago when Mike and Pei wrote the book, this was kind of the ceiling, right? This was wow, we've hit the pinnacle. We've hit the max, look at all this cool stuff we've learned. But then it was pushed beyond that. And that's what we're going to get to in the next part, because the next part is, to me, this is where all the flexibility comes in. And I think the next strategy really comes down to personality traits. These first two, I think, although there is a lot of flexibility in there, I think you could trek along and follow the methodology and be fine without any concerns. I think what intimidates people, and why I think people don't understand what we're going to get into next, is because they don't understand the fundamentals associated with making those decisions. And that's their own personality, because they see X person, they see Mike and Pei doing this and being successful. They see somebody else who they think is way more conservative and they're successful, and they don't know where to go. So first and foremost, the more tools you have access to, the better. But if you start playing around with the wrong tool that doesn't work for you, you're going to quickly realize you might be successful and you are in that path that you went down. What if you find out years down the road, you went down the wrong path? Yeah, you're successful in that path, but you went down the wrong one. So a lot of that comes down to, well, what kind of personality are you? But we will provide those options, because you'll see, and we'll get into this next time, the three of us have all shifted within the last 3 to 4 years, or you guys' case, 5 to 10 years, of what your outlook is and how things change depending on life circumstances, what you want to buy, what your achievement, what your goals are, what you're accomplishing. All of that is fluid, but all these procedures and all these options give you just that, options of how you can change and how you can pivot. So I'm excited for that. Again, you, Mike, and Pei, you guys can just go at this all day. The two of you guys, I love seeing both of you just bounce off each other, because it works so well. And I'm glad that we could finally pay you enough money to come on the show, Mike. So thank you for coming on. Just kidding.
You're getting a deposit in your account of $0.
Get a big thank you. Yeah. No, but everybody, thanks for tuning in. Again, another fun one, along with our Velocity Banking series. I think this will be a key point for people to listen to. Mike, thanks again for joining us. Pei, you as well. Excited for next show.
Bye.
Bye.